we're going to change the pace a little bit, and we're going to talk about transactions and investments. So I've got the pleasure of running the session this year. I've got a couple of great panelists to help me through this. I'm going to start off with 5 or 6 minutes just running through some slides. I want to set the scene about what's happening globally, and then diving a bit more into what's happening at a regional level. Right, so in terms of the global picture, so after the peak of 2006, 2007 in terms of transactions, we saw a big trough in 2009, and now we've seen a gradual build up again in terms of the momentum around global transactions. Where we are today, we're looking at transaction volumes of about $60 billion in terms of transactions this year. The latest numbers which we got in, so that's for year to date, the first 3 quarters, we're lagging about 17% behind where we were last year. Not so much a cyclical challenge. It has to do more with the lack of stock available for trade at the moment, and there's a few less portfolios that are in the market currently for trading. If we strip out the big portfolio sales, because they always distort the numbers, and we look at single asset transactions, we're still sitting at a level above the peak of the cycle in 2006 and 2007. But we are very much plateauing at the moment in what is becoming a very long real estate cycle. And if we talk about yields, yields in terms of global hotel investment yield expectations, they're the lowest that we've seen to date. So globally, we're sitting at about 6% at the moment. If we look at who the buyers are, of course, the big story has been mainland China. So we've had a lot of investment coming out of mainland China, particularly into mature markets. That slowed down in the last probably 2 or 3 months because of a change in government policy towards foreign investment. The guys who have been picking up the slack on that very much have been the Asian investors. So Singapore has been very strong, Hong Kong, Thailand to an extent, and some of the more emerging Southeast Asian markets have seen a lot of flows into mature markets. If we look at Europe and North America, still very much seen as a safe havens for global real estate capital, so they continue to be very much net importers of real estate capital. The Middle East has been very slow, probably the slowest period we've seen in a long time in terms of their outbound capital flows. If we look at the type of buyer, so we track most global transactions. What we've seen in terms of where we are in the cycle today is that private equity is moving out, and we've got institutional investment moving in. So generally speaking, private equity is acquisitive when the yields are higher, and where we are currently in the cycle, you've got institutional investors very much looking for yield. But that's, of course, more of a mature market story, but it's relevant to the context of where we are today in Africa and where we're going. And if we compare some of those trends in terms of buyers, again, you've got private equity and institutional investors being very much the drivers of hotel transactions globally. Within this part of the world, it's much more local investment. To an extent, there's regional investment, but the vast majority, of course, is local. Globally, you've got easy access to relatively cheap financial leverage. That's a result of the quantitative easing and a lot of cash that has gone into the debt capital markets over the last few years. Regionally, debt is pretty difficult to get on acquisitions, and if you look at the cost of debt, at times it's prohibitively expensive, but I think the session after this is going to deal with that in more detail. Globally, you're seeing a real search for yield. So there was a lot of focus on Western Europe initially, and a lot of that global capital is now flowing south towards the Mediterranean and into Eastern Europe. Where we are in Africa, we're actually still very much looking to figure out what's the right pricing level. There's not enough transactional evidence to give us confidence about where the exact yields are. And then globally, there's a highly liquid markets, whereas here, it's still relatively low liquidity when we talk about the number of transactions taking place. So with that in mind, I guess you've got a global picture where it's a long real estate cycle, there's a real search for yield, but we're not seeing a lot of that coming into Africa yet. So why is that not happening? Well, I think critically, local buyers perceive risk differently to international buyers. It's their backyard, they understand the politics, the economics better than the internationals, and that's often creating a pricing gap, or it's creating a gap between return expectations. And to give you a bit of an idea, and of course a lot of that has to do with financial leveraging, but if you're buying in Europe today at, call it 6% yield, if you're going to get the same return on equity because of the leveraging in Africa, you probably need to buy at about 10%. And that's relatively high compared to what people are willing to sell at. And the other issue, of course, in terms of slowing down transactions is higher historic development costs, which is pushing up pricing expectations. Then finally, we're certainly seeing a change in the transactional environment, and it's not a quick change, but we'd say over the next 5 years, there's some key trends that are going to be driving a change in the capital market flows here. Firstly, owners are recycling their capital into new projects, which means that there is more stock coming onto the market. We're in a very early stage of that. Developments are increasingly better geared to demand, especially in the budget space and the mid-market space, which means that returns are becoming increasingly interesting for investors. Liquidity has definitely increased, and that's going to continue to do so. I think the other key part is you're seeing more funds and platforms, and these are critical for institutional investors and global investors to put their money into Africa. It creates diversification, and it creates a more mature investment vehicle to invest into. And with all of that, once we see those additional transactions and additional liquidity, I think we're going to have a much better view of where pricing should be in these markets. We need those additional transactions to help us out. And ultimately, more transactions or more exits is going to make it easier for both equity and debt to commit more to the sector here in Africa. So from our point of view, an interesting space. I'm now going to chat to my esteemed panelists. We've got Ewan Cameron from Westmont and Shamil Manek from Merwest. To start off with you, Ewan, because you're sitting far away from me.
Hide.
Of course, Westmont is a major force to be reckoned with globally. In Africa, you're new kids on the block. What have you got in mind when it comes to both investments and transactions?
Thanks, Xander, and thanks for the introduction to the slides. I think as Westmont, we've looked at the African market for a number of years, and we were concerned with regard to how to enter the market to manage those risks. And it was only when that we felt we had the right people, we had the platform, we had some clarity with regard to how we could manage those risks, that we felt confident enough to bring in our own equity. And when we look at the market, we generally drill down to city postcode level to try and understand in each specific asset what we think is the opportunity with regard to return. So every time we're looking at an acquisition or a joint venture or whatever, and I suppose that's part of the strength we have, is we have a repertoire we can work with. It really comes down to, as you've alluded to in the slides, how we can access the data, how we can understand really what the risks component is, as well as what the return expectation should be. And in a market where there's not a lot of transactions, that's more difficult.
Yes. Yeah. And so when you talk about your investment model, you guys are pretty flexible. I mean, you could acquire outright, you could play an asset management role, you could do joint ventures. I guess when it comes to acquisitions and transactions, how do you decide what model is best?
I think it's important to clarify two main elements. One is the fact that we are specialist owners of hotel real estate. Hotel real estate is complicated, it's got risks, it's not easily convertible to another activity. You're beholden to currency, inflation, politicians, all the multitude of different complexities. So there's that aspect, and that's where we have a relative degree of confidence in the fact that we understand this asset category. The second piece is alignment. Xander. So every single time we do any deal, we're always considering how do we become aligned. So we have a repertoire from asset management, development management, ownership, joint venture, our own equity. From that menu, we're always thinking about how do we align ourselves with a partner if that's the intention of the transaction.
Okay, great. So very much about alignment. And Shamil? Shamil was a bit intimidated. He did say he's only got 2 hotels today, whereas Westmont has got 700. But he's got some great investments. You're about to open up another hotel in Nairobi.
Yes.
Hopefully next few days or weeks.
Yes.
What's your main investment focus of you and the partners that you work with?
Okay, so I think Ewan and his firm look at it from a very macro level because they have the advantage of looking at it from that angle. We only entered the business in 2013 when we opened the doors to our first property, and we're very relatively new kids on the block, and because it was a local focus, because I'm a 3rd generation Kenyan Indian, my family's been there 100 years. It was a natural progression for us from real estate development. We saw a gap in the market. Sorry.
It's a little bit closer.
Sorry. We saw a gap in the market. We saw that there's a gap for 4-star hotels, there's a gap for good service, there's a price gap, anything under $200 with a brand. So we tapped into that. Mm-hmm. But with our new properties and what we're going with right now is to look into markets where there are gaps. So there was definitely a gap in the within the airport of Nairobi, and that's why we propelled ourselves to be the force and the key player in that market. Nairobi's aviation sector is growing, and we thought might as well tap into that.
Great. You're the first airport hotel to open up?
No, there is one before us, whose tagline happens to be the only airport hotel in Nairobi. So I think they're going to have to change that in a couple of days. Okay. But no, we definitely, there's a 3rd one that's on the block coming up just outside the outskirts. So there'll be enough competition, and it'll be healthy competition hopefully between us.
Okay. And so far both hotels you've developed?
So yeah, so we developed them from ground up. Yeah. We own them and we operate them. So we have franchise agreements with our brands.
And acquisition versus development, where do you see the value?
So 2 years ago, if you asked me that question, I'd have definitely said acquisition is a no-go. You have to do ground-up development. Yeah. What's happened is the markets, at least in Eastern Central Africa, have started to mature. There's been a lot of supply coming on the chain. With this new supply, a lot of these guys are first-time hotel developers who are taking on heavy portions of debt.
Yes.
And with that heavy debt, they're not able to meet their obligations, and banks are putting pressures on them, stuff like that. So I definitely think there are very good acquisition deals that are coming up in the next couple months, couple years. And if people are looking to enter this market, I would definitely keep an eye out for that. Xander is a good contact for that. They've listed a very iconic property in Nairobi that just doesn't fit us. But if I think that's definitely an acquisition that if I wasn't in this position, I would have looked at.
Thanks for the plug. Ewan, are you seeing distressed assets, and I guess if you are, who's causing that stress? Is it the banks calling on non-performing loans, or what's pushing product into the market?
Again, I think you need to look at each individual market and understand the dynamics. My observation would be is that I think as an industry, there are pockets that are going through an adjustment. There are oversupply markets that we know of in the continent. There are situations where, as you alluded to earlier, accessing commercial debt is expensive. That's then causing parties now to be in a position where they're struggling. Owners, in some situations, are not making a return. The only party that's making a return is the bank. Yeah. And that, through time, sometimes a long period of time, sometimes relatively quickly, is making those assets distressed. Mm-hmm. Where we have in other markets, in Southern Europe, for instance, which went through a similar financial difficulty, if you like, after the financial crisis, we worked very close with a number of either institutions or lift debt providers to do restructuring. And I think there's more and more opportunity for those kind of discussions where no longer is an asset debt provider forced into doing a distressed sale, for instance. Might not be good for JLL, Xander, but I think there's other solutions there. You can look at restructuring, you can look at different, as you mentioned earlier, there's different types of capital. There's rebranding solutions, there's looking at unlocking those assets. Sometimes hotels have abundant land, so you can unlock some of that land and try and bring in some mixed use components within it. So I think where we would try and look at these situations is be creative commercially. And as Westmont, we have the capacity to manage multiple asset classifications, but traditionally there needs to be a hotel element, and then we tend to do other things as well. So I think my short answer would be I fear in some markets there will be an increase in distress scenario, and I think that's dependent upon us as an industry to be a little bit more selective about where we put our supply and make sure that demand equation fits with supply.
Yeah, good point. I mean, I think we've certainly been surprised if it's been through a relatively tough cycle in quite a few markets. There hasn't been much more distressed assets coming to market. I think there's a lot of banks still sitting with bad loan, non-performing hotel loans on their books, but in part because they don't have the asset management expertise. I think they're struggling to figure out what to do with it, but certainly from a overall liquidity point of view and a sector point of view, it would probably be positive to get these to come to market, get them to become, to asset manage properly, and get them to be repositioned to some extent to the most, relevant demand part in the sector. So, and Shamil, I mean, you don't have to invest in hotels.
Yeah.
Even if you want real estate exposure, you guys are also invested in commercial and in other real estate asset classes. What makes hotels a compelling acquisition or investment case?
So it's an interesting question because the problem with the question is that you ask yourself that question at the beginning of the when you're doing your feasibilities and when you are acquiring the sites and all that. And as your project goes along, it kind of diminishes because there's increased competition or there are things that happen in the economy that you didn't expect. However, it kind of drives you to that's why diversifying the real estate sector. So, for example, right now, there's been an upsurge within that market of short-let Airbnbs. What's happened is that residential, unfurnished units were doing very, very well. But as the supply grew, people who had 1 or 2 units, the rents started to drop quite drastically. So a lot of people became quite creative and they said, okay, let's start furnishing these and let's put them on the market and let's put them on Airbnb or rent them out to expats who are looking for this. And that is something we've done ourselves. We saw that with our residential real estate portfolio. And when we did a conversion of one of our properties, I bought out a lot of the furniture and I furnished some of these apartments, and that actually got a much better return than when they were unfurnished. Now, I'm not saying it's a hotel, but I'd sort of classify that in the same asset class.
Yeah. Short-term letting.
Short-term letting, furnished.
Okay.
Yeah.
I mean, Nairobi is clearly, if it's not already oversupplied.
Correct.
As a whole, of course,
Yes.
there's different nodes and sub-markets, etc. How do you see the distressed assets playing out in Nairobi?
So there are a couple on the market right now. You'd call them pocket listings. So they're not out in the open, but they're being discussed. Bankers will call people they know who could either take over the loan facilities or pump in the cash to turn it around and be like, let's work together and get this out of it. There's a very successful case called the Xander Portico in Nairobi, which was with somebody else, and a very experienced hotel owner and operator took it over, operated it, turned it around, and is clearing their debt pretty fast. That was a distressed asset.
Yeah.
So there are people in the market who know what they're doing and can pull this off, no doubt.
Yeah. Great. And I mean, Ewan, pretty straight question, but do you think there's good value in acquisition opportunities in Africa? I mean, you can invest anywhere you want in the world. Where do you see the value?
We're more comfortable if buying an existing asset than we are building. And I think from our current experience in project terms, we would like to see an adjustment in the construction cost. It's just proportionally too high, even in the mid-market with regard to construction. That I think we as an industry need to put more pressure on the building industry to make new builds a more viable option. I'll be interested to hear from Shamil how he's found that scenario. I think from our side, undoubtedly, you can see it in the stats. There is a lack of representation by a lot of the brands. There's historical assets in many of the major cities. There's an opportunity there to rebrand, reposition, reprovide. Some governments are starting to remove themselves and privatize those assets. Again, that creates other opportunity. And I think as the brands are about to go through another adjustment, which I think Gillian referred to this morning about the global PMSs and what's going to happen with regard to data as a system. If we, as an owner, can see a considerable upside improvement in taking a particular asset and branding it, that effectively perfects our underwriting and encourages us to put more cash behind the brand to make that happen. So we would welcome more opportunities to do conversions. We work with all the brands, Radisson, Accor, Sheraton, Marriott, Intercontinental, Hilton. And why is that? Because the brands have got strengths, and we want to try and align the assets to those strengths. And if we can find a really good, well-located conversion opportunity, if the substantials are right with regard to locality, then yeah, we would like to buy that and ask a brand to help us to drive the top line.
But you see the best, I guess, value in conversion opportunities or existing assets where you can come in, put in your asset management model, add value, and I guess get your returns in that sense?
I think normally that would be correct. So in America, that's what we did. We did that a lot in Europe. In this market, there's just less of those assets, Xander, and my kind of gentle nudge to the building industry should come with a sharp elbow, because at this point, I think in the last 5-10 years, the building industry has taken huge liberties with our industry. And what we can do is we can benchmark. I know how much a Hilton bedroom costs in Europe, so why should that cost 25-30% more in particular markets? No. And there are things here that we can use, like there are jurisdictions in Africa where you can go to the government, ask for tax concessions, provisions, which in Europe you would be laughed at. So sometimes we think Africa's more complicated than it should be, and I think there's more benchmarking transparency. Ultimately, the data should help. So as a global player, if you like, and Shamil, there's absolutely no disrespect for a local, because we both have the same objective. We want correct. Each individual hotel to make money. Yeah. And if we can help a joint venture or a debt provider to benchmark that build cost, that should mean that we get new builds in the right locations. But as I said earlier, let's make sure there's not oversupply.
No, sorry, just if I could step in. I completely agree with everything you've been saying. Absolutely everything. The building, the contractors, that they keep escalating their prices. Our returns, obviously, with additional supply and additional hotels coming up, keep dropping. So that when you asked me the first question, new builder acquisition, it didn't click to me that it was because of construction costs, but it is actually because of construction costs. Yeah. You're more likely to pick up a better return on an existing property right now and convert it than in a new build, because not only will you lose time in a new build, but there's so many variables that are starting to play out right now that it is getting more and more expensive to get into.
I absolutely agree. I mean, a lot of times in acquisitions, you can acquire almost below replacement cost for certain assets, especially when there's the value add angle. And you don't have the risk of a long development period and all the, I mean, aside from the risk that goes with development, you're also not sure where you're going to end up in the cycle. Like you said, correct. It might look fantastic when you start today, but in 3 years' time when you open, are you still going to be in a similar climate, or are there going to be another few hotels opening up at the airport?
Yeah, correct.
Good. Good, we've got exactly 5 minutes left. So I've got a few more questions, but wanted to open up the floor, see whether there are some questions from anybody.
Thank you. My name is Patrick. I come from Malawi. One of the cities in Malawi, Lilongwe, it is a growing city, very vibrant, with a lot of promise. But no serious hotel investors have shown any interest at all. So I was just wondering, is it that there is perhaps lack of information for the investors? So the question is, how do investors in the hotel space, identify these opportunities that may be there, but undiscovered? Thank you.
Okay, great question. I guess Ewan, you're slightly more broadly invested at this stage.
Thanks for the question, Patrick. To us, it's really down to data. So we try and look at what information we can get in the market. Like any investment, we try and understand what we think the returns could look like. In a market where there's not a lot of supply and where maybe you haven't got STR data available from current peer group, we look at things like mobile phone access, retail spend, disposable income, number of households. We also look at which companies are there, which organizations we already have a relationship with, already buying in that market. A lot of what you'd think about with regard to what are the revenue distributions for a hotel sitting in Kigali, we would look at the same revenue demand drivers and say, is there a demand for that market? And a recent example would be, for instance, is what's happening in commodities. Commodities has an impact on the African continent. Take for instance LNG. So you've got liquid gas coming in as a new demand driver with regard to energy. That's caused in East Africa new locations that historically are maybe leisure are now becoming commercial. That causes us as an investor to start thinking about, do I want to be in northern Mozambique? Do I want to be in southern Tanzania, for instance? Do I want to be next to Lake Albert? When we start seeing investments and transactions in other industries, we as a hotel company get interested. Why? Because we fundamentally believe that hotels are effectively base camp for doing business. The services we provide enable other businesses. So if other businesses are interested in that market as a hotel investor, we should be interested in that market too.
Sorry, can I just step in a bit? He gave a much more focused data answer. Mine would just be local advice. I mean, in 2013 when we started, we were the first branded privately owned hotel in Nairobi when we were Best Western. So it is up to you as a local Malawian community to put this forth, because your risk appetite in your home country is way more than Ewan's, for example, or mine for that matter. It's definitely something that I would encourage you to sort of, even if it's not you yourself have the capacity, I mean, take 2 or 3 friends and make it happen if that's a passion that you want to drive. And that's how you can make it happen in Lilongwe. I've been to Lilongwe, beautiful city, definitely needs really good hotels, no doubt.
Ewan, this question's for you. Westmont's backyard is largely North America. What prompted the move towards Africa? What was the driving force, or what was the real catch?
I maybe don't fully agree with the premise, but let me tell you why. The fundamentals of growing economies, larger population, the desire of brand blue chip organizations to have more exposure in this market, I mean, the fundamentals we think are there. As was alluded to in the data over the last few days, there is an undersupply of branded international hotels in the right cities. The markets are changing, so it means that, to be honest, I can look at San Francisco today and know where I should be in that city. You could say, if you look at somewhere like Johannesburg, Santon, Midrand, Pretoria, that whole corridor is literally changing before our eyes. That creates new nodes and new opportunities. Hotels are fixed, unfortunately, you can't move them easily. So I think that creates opportunities in our eyes to come in early, to get access to land and real estate maybe at better pricing than you would do in other markets, which then means our return could be improved. As Westmont, we're very comfortable with the risk. We think we understand the continent. You know, I would say 50% of my job is to build a team that understand the markets that we want to be in, so that we can de-risk and allow our investors, whether they're coming from North America, from Asia, from Europe, to have the confidence that it's a Westmont project, whether that project's in Sub-Saharan or whether it's in Northern California, it's still a Westmont project, so it gives them the confidence that it'll be the right project for them as an investor.
Great, thanks. We unfortunately we're out of time, and there's some other great speakers talking about financing. I think maybe just to wrap up, thanks so much to my panelists. When we talk about acquisitions, I guess we're saying there is some good value out there. It's certainly when we talk a lot about development in these meetings, but if you're willing to acquire, add good value, you can possibly get better investment returns in the acquisition space, certainly where we are in the cycle today, versus what you can get in the development space. So thanks so much for your input.
Thank you.
Thanks, Xander. Thanks, Shamil.
Thank you.